especially with this camera angle.
It's how do
Oh,
I make it a little bit? There we go.
yeah. Always the most inappropriate comments right before we go live. Well, welcome to News of the Money World, everyone. My name is Darcy Ongaro. Rupert Carline. How are you, Rupert?
I'm very well. How are you?
Very good. You're still enjoying the all that the South Island of New Zealand has to offer, I see, down
It
there.
is. I'm trying my hardest to stay here for as long as I can. I'm kind of feeling a little bit sorry for my colleagues in the office who get random calls at all times of the day as I think of things. But it's amazing down
Yeah,
here. Anyone that
that's
can
awesome.
make a move, do it.
Yeah, just for a little while though. Come back home wherever you're from. So today on News of the Money World, we're going to have a really, really interesting chat, and it's something that you and I have been having a chat off air about as well, especially before today. And if anyone ever really wonders how we come up with these topics, usually it's a mixture of what people ask us to cover, but also it's just stuff that we kind of go through during the week. Rupert, you're probably really similar to me. I usually have a few podcasts going on the way to and from work. I read a few articles here. I kind of think a lot about this sort of stuff, and that's kind of the genesis of today. We're talking about a commodities super cycle. So maybe what would do, just to define what a commodities super cycle is first, is just have a look at this article, and I will link to it in the notes for the audio listeners if they want to check this out as well. But a global commodities super cycle is defined as a synchronized and sustained price increase lasting more than 5 years, such as the one that occurred in early 2000s and concluded with the 2008 financial crisis. What do you think of that definition, Rupert? And would you have anything to add to that?
Um, no, I think that seems a bit right. Seems quite right. I think one of the things, the two key words in here are synchronized and sustained.
Mm,
Because for it to be a commodity super cycle, you need to see all commodities going up together. It can't just be an energy crisis or a food crisis or one of those things. It's really about everything moves up in tandem, which
sure.
generally kind of driven by a shortage of supply.
Okay. Okay. So, and we'll basically what we're trying to do is we're trying to answer uh, this question, aren't we? We're trying to answer this question: is
Yeah.
are we really going through another commodities super cycle? Because the last one was a while ago and it ended, like we said, in 2008 financial crisis, and it looks like we are almost approaching the peaks, and we'll go through a few graphs on this one today. It looks like we're almost approaching the peaks, but it's not a given that history always repeats and we always stop at the same place and then come back down. There's a very real chance we could be going to newer all-time highs here. So, do you want to talk to us around, Rupert? Do you want to just break it down in terms of the types of commodities that are in this synchronized basket that might be going through a super cycle right now?
Yeah, so typically when we talk about a commodity super cycle, we talk about a lot of the, I guess, the construction commodities. So things like copper, iron ore, coal, a lot of that stuff that's used to make things. And then also energy, so oil, gas, and then the final one, which I can think sometimes is included, sometimes excluded, are the food commodities. So in that big one for us here in New Zealand, milk, meat, grains, a lot of that stuff. It's all kind of goes in, and typically that's kind of where we know we're in a commodity super cycle when all of these things start going up together because they're synchronized, and we start to see peaks. And the big driver of a lot of these super cycles is strong economic growth, because what that has driven, the strong economic growth increases demand, and it takes a little while for supply to catch up, which is kind of why. So it's all kind of really it's a supply and demand game which drives these super cycles as well.
Okay. So we may, in a sense, we may have a lot of increase in demand, especially with the disruption caused by basically a global shutdown. And there's a lot of rebuilding. There's a bit of neglect that's happened over some period of time. And so there's definitely a need for it. But on the other side of the supply and the demand story, there is a problem with the supply, especially thanks to supply chain problems, the Chinese economy slowing down potentially, and then obviously what's happening in Ukraine. So is that kind of pretty much it. Like we've set the stage now. Like that's kind of what we're talking about, right? We're talking about, hey, there might be more demand because of neglect and there's an increased need to rebuild, but also at the same time, there's supply constraints. So are we kind of saying that those two fundamental factors will kind of persist and push the price higher from here?
Well, I think the third one we've got to remember is interest rates. So
Sure.
interest rates, the core, what is the other core ingredient for any kind of big piece of building and piece here. So, and that's where I think it gets really interesting, right? Because if you think about, lumber is a great example of one which is very, very, very highly correlated to interest rates, particularly in the US, because it's tied to house building. And that's already started to come off. So I think, yeah, I think for me, it's kind of comes back to that we are where we are because strong demand, low interest rates, and also kind of what's happening in Ukraine and Russia. But I think the real surprise is that this cycle continues on despite the global output, despite what we're starting to see in the manufacturing data, and also what we're starting to see in China as well.
Okay. And I want
Because
to
the China
kind of come
slowdown should be the ultimate thing that stops us, right? Because that's what stopped the 2008 one.
right. Oh, that's right. Okay. Yeah. So like the commodities isn't something that we normally would include in a traditional portfolio. Well, at least I haven't normally looked at commodities as a big slice of my portfolio, excluding precious metals, which there's a bit of a crossover as it relates to gold and silver, especially. Sometimes there's an investment aspect of that, and then there's a commodity aspect of that. But normally coal, gold, oil, like energy stocks, wheat, grains, all that sort of stuff. I don't normally think about that as components in my portfolio as a fund manager. So thinking about your position as a fund manager, a KiwiSaver provider here in New Zealand, are commodities actually included either directly or indirectly with a lot of the investments that are made?
Well, so there's a great question. And so there are two answers to that. First up, yep, there are some people that will trade commodities directly. So, for example, here in New Zealand, there is one KiwiSaver provider that is big on commodity trading. And they'll buy grains, they'll buy oil, they'll buy heating oil, they'll buy a lot of stuff like that. And then typically they'll do that through futures contracts. I think if you, as a retail investor, as an investor, full stop, you have to be really careful if you're going to go and buy the commodities directly, because typically these things go in cycles. And
Mm.
what that means is that you will have a low point in the cycle, and then you will also have a high point in the cycle. But oil, using that as an example, right? We know oil pretty much never goes above $130 to $150 because the moment that it gets there, it causes massive recession. And most of these commodities, we see the same things. And so that's kind of, if you're going to buy commodities directly, and you might buy that through an ETF or futures or whatever, they're very, very hard to buy in terms of they're not very good as long-term investment because often they're going to trade kind of within a band.
Mm-hmm.
So that then moves you to the second option, where again you can kind of go, so then you start to look and buy indirectly. And so if you want an indirect commodity exposure, then you'll go and buy, you could potentially go and buy something like, again, depending on what kind of exposure you want. In the olden days, you could have gone and bought BHP, and there you would have had iron ore, coal, oil, gas, phosphate, a whole lot of other things. That's a kind of, or Rio Tinto, some of those big global miners. If you're really after oil and gas as your exposure, then you might go and buy some of the big global oil companies, and agriculture, etc. I think again though, what's really hard about these companies is because markets price looking forward, often the time to buy these companies is before anyone thinks that we're in a commodity super cycle or right at the start of it, because again they're often very large companies with very high fixed cost bases, and the moment that people start to think they're starting to see the end of the cycle, that's you start to see the prices crash pretty quickly. So investing in commodities, whether that be directly or indirectly, it's definitely not for the faint-hearted.
No, I agree. And I actually, as you were talking, I just had a quick look at my Hatch portfolio just to double check that what I said was true. And no, I do have exposure to commodities in my portfolio. I take that back. So, exchange traded funds and steel and copper and all that sort of stuff. Not recommending that people do that, but that was ages ago. And I think that's the point, right? Like this is something that you don't really want to jump in at and buy it when it's the news, right? Like you don't want to do that. It's too late. So this is probably part of a long-term strategic sort of portfolio that you might be building rather than kind of a knee-jerk reaction to the news cycle. Um, but also, I kind of just think of this from the perspective of an everyday investor. There's probably a few reasons that I can think of that it would be a bit scary. Number one, it's quite volatile. Investing in commodities, often it's quite bumpy and flat for a long time, and occasionally it just spikes up for a bit, and then it drops back down again. And you don't know when. It's really hard to time that. And then also, there's a history of poor returns because of that, probably. So but there's a third element, and that's the ESG one that I wanted to kind of dig into a little bit as well. There's been this trend towards environmental, social, and good governance principles when investing, which has really made an emphasis on sources of energy in particular, which don't come from coal and oil and natural gas and all that sort of stuff. But now that the world is changing, I'm not sure that the ESG practice, all that sort of stuff, I don't know if that's changing and adapting fast enough to catch up with it. And so it might be further exacerbating or putting fuel, pardon the pun, on that fire to really ramp it up. What do you think about that? Do you think ESG is bullish for commodities?
Yeah, I do. And I think we've seen a lot of this conversation over the last 3 months, or probably 6 months now, where you talk to the people in the US and the exploration and the oil guys there who say, no, we're not investing in any new wells because fundamentally, at the moment, you want us to invest because no one likes paying $4 a gallon at the petrol pump. But at the same time, for the last 5 years, you've told us that we can't invest, we can't do new wells, no one's been willing to finance us. And you've seen basically all new exploration on oil and gas just stop for the past 5 or 6 years. You've got banks that have now got commodities, which make it really, really hard to get funding for all of this stuff. And so there's a part of me kind of goes, we've got the Russia thing at the moment, and that's created a big shock to the system. But it is really, really hard to see how there is any new exploration going on in the oil and gas space from a commercial perspective because it is so hard to fund. And what that does, remember, pricing of commodities always comes down to supply and demand. But if we're not out exploring, we're not looking for new sources of oil and gas, then that means the supply is going to drop off, as demand will most definitely drop off as well. But I think it's going to be a brave person that picks which of those two is going to come off the quickest. And that's one of the issues they're seeing in Europe at the moment, where the process of phasing out nuclear, phasing out coal-fired power plants, what that has done is that's meant that instead they've become increasingly reliant on cheap Russian gas, which now makes up 35% of their energy sources. And I think that's where it gets interesting, right? And that's one of the hardest things about ESG. What do you prioritize? Do you prioritize the E, the S, or the G? Because you could easily argue high oil prices create some terrible societal outcomes because they disproportionately impact the poor. But then if high oil prices, what that does is that accelerates the transition away from oil and gas, and it's about finding the appropriate middle ground sitting in the middle of those two things.
That's right. It's the volatility piece again. But I guess if I was involved in oil exploration, if that was my gig, I would be kind of thinking, well, okay, you need me now, but if I help you out right now and if I invest, I'm really committing to a long period of time to get a payback on that investment, to get out there, do more exploration, do some more drilling, fire up the machines again, off we go. But are you just going to turn it around and say, no, we're back on the ESG trip again, and we don't need you anymore? Like that's a really dangerous thing if you were a stakeholder in that space to go down that path. So I guess it's not just where we're at right now, it's the fear that we're going to resume down this track later on. Do you know what I'm saying there?
Oh, and we definitely will. But there's another interesting point around the oil and gas stuff, though, which is they are also massively impacted by the other trends that are happening. So they have the ESG concerns and the financing concerns, which are massive and can't be underplayed. But at the same time, they're sitting there going, hold on a sec, do I really want to go and build an oil rig right now when I've got steel prices at all-time highs? I can't get labor, I can't do this. So that's the other thing. It's as though there's not as though there's an ability to immediately go and turn on the pump tomorrow and kind of start these commodities. And so that's the other big issue to kind of which aligns a lot with what you're saying there, Darcy, because if you're going, cool, I'm going to have to make big investments today. It's going to take 2 or 3 years to come on stream. It's going to be expensive because of where labor costs are right now, because of where steel costs are right now, all of that kind of stuff. And then 3 years later, Russia's back in the ball game, and the politicians are now telling me they hate oil and gas again.
That's right. That's right. Do you play chess, by the way, Rupert? Are you a chess man?
No, I'm nowhere near smart enough for that.
Right. Okay. When like last week when we had our last episode, I was staying in a place in Rotorua with the family, and they had one of these massive outdoor chess games, and so I took my 5-year-old girl out there, and we were playing chess, and that's an interesting experience. She loves it, but it got me because I used to really be into chess quite a bit, but it really reminded me of just how important it is to understand the interconnectedness and uh, the multidimensional aspects of building wealth and investing when we are subject to so many things that we cannot control. And as it relates to commodities in particular, right? Like I'm thinking about gold, sorry, not gold, I'm thinking about oil. Um, Here is a chart, I believe. I'm just showing on the screen right now a chart of, is it oil? Yeah.
Yeah.
Just showing where we are. And in the gold there, it shows the previous all-time high. So again, we're really close to the all-time highs in the previous super cycle, and I'm reminded of just what happened. Even I think it was last week or the week before, where Russia goes to Turkey to sign a deal. I guess this was partly initiated by the UN. I'm not sure, to allow the export of grain from Ukraine, from the few remaining ports of Ukraine. But then just even today, I think, or yesterday, there was another attack on the second of 3 ports to try to disable them, presumably by Russia. And you just wonder, well, just as soon as you think you got it figured out in terms of what's going to happen with the price of grain because of shortages or an ease up in the bottleneck, then next thing you know, there's something else that we didn't see was cooking, and now actually Putin was doing that because of a different reason. So is that why often, I guess, investors shy away from going down the commodity piece, because it very much is intricately connected to the global economy and geopolitics, and it's so easy to get lost in that tangled ball of string, right?
Oh, massive. I mean, geopolitics is such a humongous one, right? And so you even think of a company like Glencore. So Glencore is currently, so it's an interesting example, right? So one of the largest, initially they were kind of a very large trader of commodities. And then they ended up kind of moving upstream, buying mines. They're a large Swiss company listed on the London Stock Exchange probably 10 years ago. But again, so because they operate predominantly in Africa and other places with quite weak governance, they're now completely on the hook for having kind of issued bribes and basically operated in a way that they needed to operate in to work in those kind of countries, but that goes completely against Western standards. And so, not only that's a really good example of a company which has kind of not only exposed to the cycle, but now completely exposed to political risk, can be completely shut down as and when they want. I mean, a good example of the political risk that these guys will face, I think, is in the US, where Exxon Valdez, when ExxonMobil had the crisis up in Alaska, where the Valdez kind of leaked a whole lot of oil into these pristine fjords up in Alaska. The penalty was almost nothing. It was kind of, admittedly, there was a bit of time in between, but the penalty, I think they ended up having to pay kind of $250 million of restoration, or maybe 500, but it was a pretty small number. You think 15 years later, when you saw BP, because they were a British company, they had their issue down in the Gulf of Mexico, and they had to pay $20 odd billion in reparations and restorations. And then that's one of the other kind of issues with the commodity companies. Not only are you exposed to the cycle, but you're exposed to politics and so much other stuff that makes it a really, really, really hard investment.
Yeah, yeah, and you can see why it's
Oh,
it's such
completely.
a game of strategy, right? Like it's such, like geopolitically, it's such a game of strategy, looking for the weakness in your opponent and waiting for the best time to strike when they're all preoccupied with greenwashing, for example. It's
Yeah.
so hard because
I
it
mean,
gets entrenched.
and even New Zealand, right? Where kind of all of a sudden for us, it was kind of a very surprise ban on all new offshore oil drilling and people that might have been thinking about coming here or had purchased rights. I mean, yeah, it's a really, really hard game to win in. And
Mhm,
that's why it's generally the big guys that win or people that
mhm,
are willing to take exceptional amounts of risk.
mhm. Okay, well, now let's just talk about two countries in particular because it is kind of important around the commodity piece because they are either a big producer and or a big consumer of a lot of the commodities that we're talking about here, Russia, China. We know a lot about Russia because we're being bombarded with those messages at the moment. Um, China or China, aka Donald Trump's version of China, is that like tell us about where China's at right now because they're going through an interesting time in their economic cycle. So give us a lowdown on where China's at.
So China's clearly going through a massive slowdown. They have been unable to shake COVID. They kind of haven't quite figured out exactly where they're going to go between trying to kind of maintain a zero COVID policy to a low COVID policy. They've still got closed borders. There is no way they're going to hit their 6% growth target this year. Um, and at the same time, they're starting to crack down massively on a number of their kind of industries, and you're kind of starting to see the property and home buying sectors also kind of come off a cliff. The other thing that's really interesting about the Chinese economy is the demographics are actually really bad because of the one-child policy. What you have is you've got kind of a working age population that's starting to shrink pretty rapidly as well. And so the why this is all so important is over the last kind of particularly over the last 20 or 30 years, a lot of this super cycle in terms of coal, iron ore, food, a lot of that kind of stuff has been driven, not so much grains, but definitely the New Zealand meat commodities such as meat and dairy, has all been driven by a growing China and a China that has built, it's gone from having almost no infrastructure to having a pretty great infrastructure. And so, what I find fascinating is that we've still got pretty high commodity prices off around the board when we are also starting to see such a material slowdown in arguably, I think not arguably, in the largest importer of commodities around the world. And so that's where it's going to get really, really interesting. And I think for a country like New Zealand, where, let's be honest, we don't like to think about this, but we are a commodity exporter,
Mm,
that's going
mhm,
to make life a really interesting example of how does a Chinese slowdown impact us? How does it impact Australia, who one of our second largest trading partner? Because again, those two are kind of intrinsically tied through the iron ore and coal. So yeah, it is going to be interesting. It's kind of to me we have started. It's interesting that commodities have held up so long given those growth concerns in China. Though over the last probably 4 to 6 weeks, we have started to see the commodities come off, and I think a lot of that is due to well, I guess it's a combination of a global, but in particular, increasing confidence in a Chinese slowdown.
mhm. Okay. Yeah, it's interesting times, isn't it? This is fascinating. So
Oh,
there's a lot of pieces though in the puzzle to try to sort of figure out, right?
but there are, but where I find it gets even more interesting is, and then when you kind of go, and this is why I think commodities, I find I struggle with them as an investment. It's actually from an investor's perspective, when things go really well in the commodities, it's actually the second order impacts, right? So oil is a great example, right? Basically, the world relies on oil. It might only make up 3-4% of global GDP, but it is an input cost into so much and so many different kind of parts of the world. And
Mm,
so there's a really strong view that back in 2008, it was widely acknowledged that about $120 was the oil price that would pretty quickly tip the world into a global recession. inflation kind of, they think now that might be $130, $140, but it's just really interesting. So as a commodity investor, when you get what you want, you know it's going to be pretty short-lived because fundamentally you end up in a world where you've pushed the world into recession.
Hmm.
Grains is another really interesting example, right? Last time
Hmm.
we went through a bit of a grain crisis and really, really high prices on grains. What we
Hmm.
saw, that's what drove the Arab Spring, 2011, right? So countries like ours in the developed world, where grains and raw commodities only make up maybe 10% of the food costs and kind of when it gets to supermarkets. But if you're operating in kind of third world countries, the actual grain cost can make up 30 or 40%. And so when
Hmm.
grain costs has tripled, quadrupled, that's going to have a massive impact on people's ability to eat, particularly in countries which can't afford it. So that's probably where I find it really, really interesting is actually, yeah, it's kind of what the commodity prices do to the rest of the world and the rest of the economies on the way through.
Yeah. Okay. Because it's like you say, it's a second order impact. It's like when you go further and further away from the actual commodity price itself, you get a function of that price. And so it's like a derivative of that price because it's an input of something else that's required. Eggs, chickens eat grain, I guess. Um, I don't know. That's a really basic example, or just the raw materials that make up EVs. There's so many areas where this applies, right?
Oh, 100%, right? EVs is another really great example, right? Where, again, it'd be interesting to see what happens. You've got the lithium issues and the lithium crises that's kind of getting to there. But actually, all of a sudden, if we see oil back down at $20, what does
Mm,
that do to the uptake of electric vehicles? We saw that back in
mm,
2008, 2009, when all of a sudden electricity prices kind of plummeted because we saw coal prices and gas prices and oil prices plummet. Solar
mm,
went from being the hot thing in the world to basically nothing, and it took about 5 years for the solar industry to recover. So
mm.
yeah, it's really interesting where it all goes.
Yeah. And just to cover off a question here from somebody who's listening in, Kathy Brown. Thanks, Kathy, for asking this question. So, what levers can New Zealand pull with a slowdown in commodities? So, I guess thinking about, say, Fonterra, for example, firing off all this milk overseas makes us pretty dependent on that income. And if there is a slowdown, if that comes off the boil, are we in New Zealand pretty exposed? And should there be some levers that we pull to kind of make ourselves a bit more immune from some of that volatility? What do you think?
Oh, look, there's no question we are massively exposed to a slowdown in commodities, right? Whether it be meat exports or milk powder, it's sent off as a raw commodity in sacks. You go lamb and a lot of the meat that we export now, we're actually not even really processing a lot of that meat. It's simply sent in, the carcasses are quartered, put in a freezer and sent offshore to be dealt with.
Hmm.
I think that the honest truth is the way in which, and everyone says this, it's a pretty easy answer. I just got no idea how. The way in which we can insulate ourselves from commodity cycles, it's got to be to think about how do we move up the value chain? How do we kind of stop sending off raw milk offshore? And how do we start sending higher value add products? How do we build out more productivity, whether it be tech or whatever we're doing? But we do need to figure out a way to export our farming systems, export technology, export kind of high value products rather than exporting raw commodities. I think Ireland's a really great example of this, where they saw this pretty early on. Um, and what they did is, again, what they did was Kerry, which was their kind of Fonterra equivalent over there. They have managed to go upstream, and therefore the farmer return is now kind of much more of a blended return from commodity plus value add versus ours, which is still largely commodity. Russia was another really interesting case study in this with what they did with their wood products about 10, 15 years ago. They banned the export of raw logs
Hmm.
because they took the view that we want to take the processing margin here. We want to make sure, and so they basically banned the export of raw logs, or made it very, very difficult to do. make sure that they ended up building out quite a strong, successful wood processing industry domestically.
Hmm.
And I think potentially we need to be a bit braver about making some of those decisions around going, actually, what do we want to export? What do we want to have onshore? Or
Mm.
are we just going to be consistently the low cost, high quality provider of product offshore?
Hmm.
But so as long as we do that, we're always going to be the price taker.
Yeah. Well, using that word value chain, or the first part of that value one, let's finish up on this one, Rupert, because I just think this is interesting. I love
So
gold,
I
right?
just got
Yeah.
Kathy's actually given. So I'm just going to answer
Oh,
Kathy's
right.
before
Yeah,
where
that's
she
right.
said,
She's given us a
I've
response.
heard that answer for over 20 years. Always hopeful.
Mm,
My argument back to that one would be, we've never had anyone that's been that brave, and no one has been brave enough to make some of the harder decisions that need to be made to do that. And unfortunately, there's no such thing as a free lunch. And so, therefore, if we want to do that, if farmers, if politicians want to do some of that stuff, it's just not, they're not easy decisions to make. But until someone is willing to do that, nothing will ever change. That I do guarantee.
yeah. Okay. And thanks again, Kathy. But let's talk about gold, because I love gold, and I think
I
I
know you
really
love
like
gold.
gold. Yeah, I think it's fantastic, and this is a really interesting chart. Like, the reason why I love gold, though, just really quickly, and we will finish up soon here. It's a store of wealth. It's a play to, I guess, position oneself against some sort of monetary reset, which used to sound very fringy and not so much anymore. But it's also a commodity. It's one of the commodities. And here's a nice little graph of what it did in 2008. And if we look at what it's done so far, it had a bit of a false start uh, when, I guess, right before the pandemic, but it's kind of been maybe manipulated, I don't know, suppressed, but that can only go on for so long. And then looking what happened through the last cycle, whew, what do you think, Richard? I mean, not Richard. What's your name? Rupert? What do you think, Rupert?
Today I'm Rupert. Um,
Today you're Rupert. That's right.
look, look, I struggle to understand gold. I've never done much work on it, I think. But I do find it fascinating that it's meant to be the ultimate hedge in a high inflation world. And it hasn't kind of really played out to be that, because we're in a high inflation world. The prices have stayed low. And so, yeah, I'm just not really too sure what's driving it. One of the
Mm,
questions I'd beg to ask is has there been, do we think cryptocurrencies and Bitcoin in particular have taken some of the demand out, right? Where we
mm,
know,
mm,
particularly for a lot of the retail holders, and the other issue with gold is there's not a huge amount of supply. Um,
mm.
so is it that actually the gold price has been a little bit suppressed because now there's an alternative to that kind of inflation and
Yeah,
inflation hedge?
maybe. We'll see. Time will tell. Time will tell, but sometimes it takes a while for good ideas to bear fruit. We'll see. We'll see.
Does.
All right. Well, that's definitely enough of both of us chatting today. So if you've been watching and listening, and thank you, really appreciate that. And this will go out on the audio probably tomorrow on the podcast. So that's awesome. And Rupert, any final words of wisdom before we finish up for this week?
No, nothing from me. I think commodities are fascinating. Let's be fascinating to see, revisit this conversation in 6 months' time, and we'll probably be having a completely different conversation.
Yeah, let's see. Let's see. Awesome. Well, you have a good one, and we'll catch everyone next
Yeah,
time.
you too, and we'll speak next week. Thank you, everyone.
Cheers.